Proposed changes in how the Hong Kong Insurance Authority evaluates non-life insurers' required capital levels could bolster the market's position as a global reinsurance and risk management hub. That according to a new AM Best commentary. Here to discuss the proposed changes is James Chan, director at AM Best. So James, can you give us a backdrop here on what prompted this review and change by the Hong Kong Insurance Authority?
Sure. The Hong Kong risk-based capital framework was initially rolled out in July 2024. So it is approaching 2 years since its adoption. And now it is a good opportunity for the regulator, the Hong Kong IA, to review the regime's operation, taking into consideration feedback provided by the market participants to identify areas where some refinements could be made to allow better alignment of capital with underlying risk, and at the same time potentially uplifting Hong Kong's position as a global risk management hub while maintaining appropriate prudential safeguards. So on 11th of February this year, the IA launched a public consultation on proposed amendments. There are multiple proposed changes, including preferential treatment for eligible infrastructure investments, provisions to require capital for general insurance business, such as natural or man-made cat risk, and some technical adjustments for life products, such as index universal life. And then there are also proposed refinements to require capital amounts for digital assets such as crypto assets or stable coins. These proposed changes also help to align the overall framework with international practice. The IA has positioned the Hong Kong RBC as consistent with insurance core principles stipulated by the IAIS, as well as other global ICS developments. But it acknowledges the need to tailor to local market characteristics. So with that, an early stage recalibration after observing real-world impacts is indeed in line with how other regimes have been fine-tuned in the past post-launch.
How will this measure improve capital efficiency for Hong Kong's non-life insurers?
Sure. We think that there are some proposed changes that would have a more profound impact on Hong Kong's non-life segment. In particular, natural cat risk, man-made cat risk, as well as the proposal to potentially, allow offshore asset and liability for general reinsurance business to be excluded from the calculation of solvency. For net cat risk required capital, the IA proposes to reduce current net cat risk required capitals for non-life insurers. For example, some prescribed natural cat risk factors are scaled back. And then the IA also proposes to allow greater diversification benefits across different markets in the Greater China region. And then also a multiplier to reduce the overall net aggregate annual losses. These revisions will lower the capital burden from cat risk charges for non-life insurers or reinsurers. Those entities who have a more meaningful overseas portfolio would see a more prominent and immediate RBC benefits. For man-made cat risk, the IA also proposes scaling down some man-made cat risk capital amounts by the ratio of relevant premiums written to some prescribed thresholds. This adjustment is expected to provide capital relief for some smaller non-life insurers with more concentrated large risk exposures. In addition, the IA also proposes to let certain non-life insurers to exclude from their solvency capital calculations assets and liabilities related to general insurance offshore business, subject to their non-Hong Kong insurance group parent being equipped with strong financial health and a good credit history. In addition, they should follow a prudential capital regime and be able to provide explicit documentation of parental support to assist or to support the subsidiaries when needed. By aligning capital standards with local market characteristics and maintaining international prudential benchmarks, the regulator seeks to balance the segment's sustainable development with policyholder protection. AM Best views the above proposed changes as overall credit positive, since they reduce CAT-related capital strain, improve the recognition of diversification, and enhance capital efficiency while preserving prudential safeguards.
James, what are the implications for Hong Kong's insurers with the ability to write offshore business?
The proposed changes bring growth opportunity, particularly for insurers with offshore net cat risk appetite and for international subsidiaries of eligible non-Hong Kong insurance group parents. Hong Kong's direct non-life market remains highly fragmented and competitive. There are more than 80 pure non-life insurers as of September 2025. And over the past 5 years, the segment has experienced subdued growth in the low to mid-single digits, mainly constrained by economic headwinds and the broader economic slowdown in mainland China. Consequently, the proposed solvency framework adjustments are viewed as catalysts for insurers, especially for domestic direct insurers who are equipped with strong capitalization, robust underwriting know-how, or with favorable parental support to potentially pursue growth opportunities outside the local market. This may enhance capital efficiency at the group level and promote offshore inward reinsurance at the Hong Kong-based subsidiaries. Meanwhile, AM Best still expects the IA will approve cautiously to maintain appropriate prudential safeguards for offshore policyholders.
That was James Chan, Director at AM Best. You can find the full commentary online at ambest.com. For AM Best TV, I'm John Weber.